And welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are making a journey towards financial freedom, financial well-being, financial products so you, like me, can reach your goals sometime in the future. Now let's get to the latest video. Now this latest video is about my ICE review for the month of June 2024. Now not to boast or brag or say look at me, but to say well if I can put up a size profile with over six figures, so can you if you take a plan, put kind of action in place and think long term. Now, what are the aims of the portfolio? So, year annual growth of 10%. For 2024, we're looking for dividends of £3,600 and a year-end value of £113,000. So, how have we done the month? Well, we started 110,807, ended the month at 113,485. So, profits in the month of 2,678, year to date 13.51%. So, a very good run during recently. Our contribution during the month was £316, so year to date £9,857. Now our platform provider AJ Bell charges fees of £15.06, so it's based upon a percentage of our portfolio value, but fees are normally about the same amount. So where is the portfolio held? Well, predominantly UK based in Europe, so 59% in UK and Europe, 28% in America, and 12.5% in Asia and emerging markets. What sort of dividends have we received during the month? Well, let's look at the following graphic. A very nice month. £947.64. A yield across our 15 shares of 6.14%. So year to date, £2,666.26. We're expecting £800, so £866 ahead of target. But dividends will be reduced, so we say July, August, and then come back up again September, October. So what dividends have we received during the month? Well, L&G gave us a nice dividend of £623.78, 232 new shares, but it's got a yield of about 9%. Will increase dividends year on year. HSBC gave a quarterly dividend of £124.88, including the special dividends, gave us 17 new shares which are reinvested. AJ Bell, the platform provider, gave us £30.77. We decided to reinvest. We got 7 new shares because it seems a growth company, but the dividends at the moment are quite small. And then a nice surprise, Card Factory, £168.21. Dividends have been reintroduced after a few years with not paying because of banking restrictions, but we received, shall we say, 179 new shares. So a very good month. Remember, if you like the videos, smash the like button, subscribe to the channel so you can reach a wider audience. Now let's get into the holding within our portfolio. So first of all, let's look at our shares. So at the moment we own 10 shares, 7 in profit, 3 in loss. 45% of our portfolio, which is £48,566, of which 38% in the FTSE 100 and 5% is in the FTSE 250. So what holding do we hold? Well, our largest holding is Lloyds, the banking group, 19,807 shares, £11,000, nearly 10% of our portfolio. Banking results have been good recently, profit margins are up, a long-term hold, hopefully recovery play, but it has struggled in the past, but is now, shall we say, on an upward trend. L&G, the insurance company, 4,189 shares, £9,600, 8.5%, and as we said, very good dividend year. The month yield around 9%, just switch off. We also own Aviva, second insurance company of 1,854 shares, £9,000, 8% of our portfolio. Again, yield about 9%, very cash rich, restructuring plan, but very good dividends also. We own Card Factory, the retailer, 3,917 shares, £3,600, 3% of our portfolio, very cash rich. Dividends was reinstated after the pilot, but it is, shall we say, expand the high street, and it's got very little debt. But as I said, very good cash rich generating company. We own HSBC, the banking group, 530 shares, £3,700, 3% of our portfolio, and as we found out in the month, a very nice quarter dividend and a special dividend paid. But it was done because it was, shall we say, solely on UK banks. We own Barclays, 1,631 shares, £3,500, 3%. Again, a nice yield around about 5 or 6%. And NatWest, 992 shares, £3,000, 3% of our portfolio. Again, a nice dividend. There was the plans for the sell-off, but obviously been scrapped because of the impending election, as of the results. But now, the UK government now own less than 20%, so it's getting there on a gradual basis. The shackles are off. We own AJ Bell, the platform provider, 731 shares, £2,800, 2.4%, but a small dividend a month, but it is, I would say, a cash-rich or a growth company. We own Phoenix, the life insurance pension provider, 443 shares, £2,500, 2%. Our latest acquisition, but it's got a yield of around about 10%, and it's just announced paying some debt off, and it's just announced a restructuring program. So a long-term play within, shall we say, the pension sector. And then finally, we own Sainsbury's, the retailer, 881 shares, £2,300, 2% of our portfolio. Everyone needs food, everyone needs to eat. Results were not great recently because of Argos, but it is cash rich and it will pay a very nice dividend during the month of July. So, some well-known companies, all long-term buyers. We've got no reason to sell any of them shares, but they were done for a specific reason. Predominantly based in financial services, what we know about, but we just switch off, does what it says in the tin. And as we found out, some very nice yields and dividends paid within the month. Now let's look at what funds we hold within the portfolio. With regard to our funds, again we own 10 funds, 5 in loss, 5 in profit. 55% of our portfolio makes up £62,500. So where are the funds held? Well, following graphic, we've gone, shall we say, into some kind of ETF funds. Our largest fund is the Passive Adventures Fund from our platform provider, £23,000, 20% of our portfolio, giving us a return of around 10% a year and very low fees, but it was done for the diversification because we were, shall we say, solely UK based. We own an LNG technology fund, got about 700 stocks, £14,000, 12% of our portfolio with very low fees, and the tax have allocated one during recent years. We own a Fidelity World Index fund, again done for diversification, very low fees of 0.12%, owns about 3,500 stocks, but £9,000, 8% of our portfolio, and it's one we are topping up. So last month we put £300 into that fund. Now some funds that have struggled are a Fidelity China fund, £2,500, 2%, an emerging markets fund, £900, 1.6%. Hopefully they'll recover, but they've struggled ever since the COVID. We own a mid-cap fund of £1,900, 1.5% of our portfolio, and a second emerging market fund of £1,300 of 1.1%. Our smallest fund is a Russia fund. We put £500 in, went up to £60 plus, everything was great. Russia-Ukraine conflict came, it's struggled ever since. We're not going to sell at a loss, but thankfully it's £230, makes up 0.2% of our portfolio. Who knows what will happen moving forwards. 2 shares we bought recently, we ring-fenced some money for a specific purpose. We put £3,000 in an S&P fund, it's now worth 3.2, so 3% of our portfolio, and we put £5,000 in an FTSE all share account, so it's now worth 5,470, makes up 5% of our portfolio, but it was done to ring-fence. We needed it for a purpose in future, but we didn't want to add to our existing holdings. So a collection of funds, 10 funds. Hopefully the emerging markets China fund recover. We then must simplify it into our passive funds, just to, so we say, ease of management and reduce costs. Okay, but remember, they're my own personal opinions. But it just goes to show, if I can build a sizable portfolio, you can too. If you take the steps, take the plans, think long term, and more importantly, invest within a tax-free investment wrapper. So all growth is tax-free, no capital gain tax, and all your dividends do not have to be declared. There's no dividend tax also. Remember, if you like the videos, smash the like button, subscribe to the channel, and we'll see you again in the next video.